Welcome to the deep dive, where we take the sources, the articles, the spreadsheets, the dense research, and really just extract the critical knowledge you need.
Today, we are handing you what is, I think, the essential lens through which all financial decisions are viewed. It's really the indispensable tool.
It underpins everything, right? Corporate budgeting, your mortgage payment.
Everything. We are undertaking a comprehensive deep dive into present value, which you'll often see called PV, or sometimes present discounted value, PDV.
Okay, so let's unpack the central dilemma that, I guess, drives this entire mathematical universe. It's a simple idea, but it's actually pretty profound. It asks, why is a dollar today worth more than a dollar tomorrow?
And that question, that single question, encapsulates the time value of money. It's not just some, cute phrase. It is a fundamental economic reality.
The dollar you're holding in your hand right now is inherently more valuable.
It is more valuable than the promise of that exact same dollar next week or next month or, a year from now.
And why is that?
Because the moment you possess that dollar, you gain immediate, tangible exchange value. You can spend it, of course. But more importantly in finance, you can invest it. It has the potential to start earning interest immediately.
Setting it on a path to accumulate a value greater than $1 by tomorrow.
Exactly. And when we talk about present value, what we're really doing is formally defining the current worth of an income stream, or even just a single lump sum that you expect to receive sometime in the future.
So it's a translation process. You're translating a future promise into an exact valuation today. You're trying to figure out its fair price right now.
Precisely. And to understand PV, you really have to contrast it immediately with its opposite, future value, or FV.
Okay.
Future value asks, if I invest $100 today at a certain interest rate, what will it accumulate to in, say, 5 years? It's a projection forward in time.
Right. But present value flips that completely.
It asks the inverse. It asks, if I am promised $100 5 years from now, what is the value of that promise to me today, factoring in that same interest rate?
So the general rule, which we operate under for, 99% of conventional finance,
Almost always.
is that the present value will always be less than the future value. And that's because money has that interest earning potential over time. You're sort of mathematically penalized for having to wait.
That's absolutely right. But, the sources point out a fascinating, though very rare, scenario. The exception where PV could equal or even exceed FV.
And that happens with negative interest rates.
Yes, negative interest rates. We've seen this crop up in certain economies, like in parts of Europe and in Japan, where central banks were pushing rates below zero.
That's so counterintuitive. How does that flip the entire equation on its head?
Well, think about the cost of just holding cash. If a bank charges you a fee, which is what a negative interest rate is, just to hold your money, you're actually incentivized to take that cash out today.
Right. You'd rather hold it yourself or spend it.
Exactly. So in that environment, the penalty is for waiting and leaving the money in the system. Therefore, the present value of $100 today, which avoids that fee, might actually be deemed more valuable than the future value of that same $100, because that future amount is going to be eroded by fees while you wait.
But like you said, that's highly non-conventional. So for today, for this deep dive, we're focusing on the foundational principles of positive interest rates.
We have to.
So our mission then is pretty straightforward. We're going to unpack the mathematics, the complex formulas, and the really practical applications of present value.
And by the time we wrap up, you will have the mathematical language to translate time into dollars.
Which gives you a serious competitive advantage in understanding how loans, mortgages, annuities, and investments are truly valued.
Okay, let's start with the fundamental human behavior that's really driving this entire mechanism, the rational choice.
Economists call this time preference, right?
Exactly, time preference. If you are offered $100 right now, no strings attached, or a guaranteed $100 1 year from now, assuming a positive real interest rate, a rational person will always choose the money today.
And that choice isn't just about impatience, though I'm sure that plays a small role. It's really about opportunity. That $100 today represents an immediate opportunity.
What kind of opportunity?
Well, I could use it to buy something I need, obviously. Or, more relevant to finance, I can immediately put it to work. I can put it in a savings account, a bond, any asset that starts generating a positive return instantly. That immediate access to value, that's liquidity.
Precisely. If you choose the $100 today, you've sacrificed nothing. You've maximized your opportunity. But if you choose the $100 in 1 year, You have sacrificed the opportunity to use and to earn interest on that money for an entire 365 days.
So that sacrifice of immediate access, of liquidity, it has to be compensated for financially.
It must be. And that compensation is interest. Interest, in its purest form, is the financial compensation required for delaying consumption. It's the premium a borrower has to pay to a lender for the privilege of using money right now.
I've always found it easiest to understand when it's compared to rent.
It's a perfect analogy. Think of a property owner. They give up temporary use of their property to a tenant, and in return, the tenant pays rent.
The title never changes hands, but that temporary use is paid for.
It's the same with money. Interest is the rent paid by a borrower to a lender for access to money over a period of time. The lender temporarily sacrifices the money's exchange value, their ability to go out and buy something now, and they're compensated for this sacrifice with interest.
So the key takeaway here is that the initial borrowed amount, the present value, is always going to be smaller than the total amount eventually paid back to the lender.
It has to be.
It makes perfect sense. The borrower gets the access now. The lender gets paid for waiting and for giving up their own immediate opportunities. So to formalize this, we need terms for projecting value both forward and backward in time.
We use two distinct inverse operations. First, you have capitalization. Some people call it compounding.
Okay.
This is the operation of taking a present value and projecting its growth into a future value. So if I have $1,000 today, I use capitalization to ask, how much will this $1,000 be worth in 3 years given a certain interest rate?
So you're growing the money forward.
Exactly. And the reverse operation, which is the whole focus of PV, is discounting.
Right. We start with the future value and work our way backward.
We ask, how much is that $1,000 I'm promised in 3 years actually worth to me today? In this process, we are, in a sense, peeling away the compensation, peeling away the rent that would have accumulated over those years.
To find its true value in the here and now.
To find its true value right now. Let's use a very specific example to really nail down this idea of equivalence. This is the point of indifference for a rational investor.
Correct.
Imagine an incredibly safe investment, like a high-yield savings account or a government bond, and it offers a guaranteed 5% interest rate annually.
Okay, so if I choose to receive $100 today, I can deposit it. And in 1 year, I'll have $105. Simple enough.
Exactly. Therefore, for you, receiving $100 today is financially equivalent to receiving $105 in 1 year, provided, of course, that you can reliably get that 5% return. That point of indifference is the key to all of this.
Which means if someone came to me and offered me $104 next year, I would refuse it.
Or
Because I can generate $105 myself just by taking the $100 today. So I'd only accept the offer for next year if it's $105 or more. If they offer me $106, I'd probably wait.
And that is the mechanism of discounting in action. That 5% rate essentially determines the minimum premium that's required to get you to delay the receipt of cash.
Now, there's a critical detail from the sources we have to mention here. These base calculations, they all assume zero risk of default, right?
Absolutely. That is a crucial assumption. They assume the promised payment is guaranteed or that any potential risk has already been accounted for inside the rate we're using. We'll dive much deeper into that risk adjustment later on.
Okay, so since interest is the engine that drives this whole valuation process, we really need to get extremely precise about the language of interest rates. We've established it's the compensation for the time sacrifice.
Interest is the additional amount gained or paid between the beginning and the end of a time period. It represents that time value of money. But the speed and the magnitude of that value growth depend entirely on the compounding period.
Right, this is the length of time that has to pass before the interest is actually calculated and credited or, added to the total principal amount.
And I think this is where many non-specialists can get a little bit confused. If interest is compounded quarterly, it happens 4 times a year. If it's daily, it's 365 times a year.
And crucially, the interest rate we use in our formulas, which we just call, it always has to be the rate for that specific compounding period. You absolutely have to match the rate to the period.
That's a non-negotiable requirement for accuracy. And it forces us to confront the fact that we don't just have one interest rate. The sources detail 7 common types used in financial modeling, And understanding the nuance between them is really the difference between true financial literacy and just, plugging numbers into a formula.
Okay, let's start with the two fundamental ways that interest grows.
First, and by far the most important for long-term investing, is compound interest.
This is the exponential process.
It is. The interest you earn in one period is immediately added to the principal, and then the next period's interest is calculated on that new, larger total. It's earning interest.
Which leads to that characteristic accelerating upward curve of growth. It's the bedrock of retirement savings, long-term bonds, all of that.
Absolutely. Now, contrast that with simple interest.
Which is just additive, not exponential.
Correct. The interest is only ever calculated on the original initial principal amount. The interest you earn is never reinvested or added back into the principal to earn more on its own.
Where would you even see simple interest used? It seems so basic.
It's typically for very short-term loans. Think of some short-term commercial papers, or historically some basic treasury bills.
Yeah.
If you lend $1,000 at 10% simple interest for 3 years, you just get $100 per year. The total payback is $1,300.
But if that was compound interest?
The final amount would be $1,331. And that $31 difference, even on a small amount like that, really illustrates the power of compounding over time.
Okay. Next up, we have concepts that are tied directly to the frequency of reporting. This is critical for, comparison shopping between loans or investments. You often hear banks and lenders quoting one of two rates.
Yes, and the first one, the effective interest rate, is the gold standard. This is the rate that is truly earned or paid over a full year, no matter how often it compounds. It incorporates the effect of that compounding.
So if Bank A offers, say, 7.8% compounded monthly, and Bank B offers 8% compounded annually.
The effective rate allows you to compare them on an apples-to-apples basis to see which one is actually the better deal. It's the true cost or the true return.
And then we have the one they often put in the big font on the advertisement, the nominal annual interest rate.
Right. This is often the headline rate. It's the simple annual rate of multiple interest periods, but it completely ignores the effect of compounding.
And lenders love to use nominal rates because they sound lower, don't they?
They do. For instance, an 8% nominal rate that's compounded quarterly actually yields an effective rate that's closer to 8.24%. You must always, always ask for the effective rate to know the true financial impact.
Okay, the fifth type is the discount rate.
We use this implicitly in our PV calculation. It's conceptually the inverse of the return rate. It's the rate we use when we perform calculations backward in time. It's the rate we apply to discount the future value back to the present day.
We also have theoretical limits, which are more for advanced finance, starting with continuously compounded interest.
This is a beautiful mathematical concept. It really is. It's the mathematical limit of an interest rate. The compounding period approaches zero time. So instead of compounding daily or even hourly, it's just constantly compounding every second, every millisecond.
Does any real-world account actually do this?
No real-world deposit account compounds continuously. But the concept is absolutely essential in modern finance, especially for pricing financial derivatives and options contracts. The famous Black-Scholes model, for instance, relies heavily on the concept of continuous compounding.
And finally, the most critical one for economic realism, the real interest rate.
The real rate is essential because it accounts for the erosion of your purchasing power due to inflation.
And the calculation is simple, right?
Very simple. You just take the nominal interest rate and you subtract the inflation rate. If you earn 5% interest on your investment, but inflation during that same year was 3%, your real rate of return, your actual increase in purchasing power, is only 2%.
And if inflation is 6%, your real rate of return is negative 1%. You've actually lost money in terms of what you can buy, even though your dollar amount went up. That breakdown clarifies the language beautifully. But it kind of circles back to that initial technical requirement. You have to modify the rate if it doesn't match the payment frequency. Why can't I just take an annual rate and divide it by 12 for a monthly payment?
Because if you simply divide an annual rate by 12, you are assuming simple interest for those 12 periods. But we know money almost always compounds. So if you use a monthly rate that's just the annual rate divided by 12, you will understate the final effective annual return.
Because you're ignoring the interest that should have been earned on the interest from months 1 through 11.
Precisely. So we need a formula that ensures the total annual growth is equivalent, whether we calculate it once at the end of the year, or 4 times quarterly, or 12 times monthly.
And there's a specific formula for that.
Yes. If a bank quotes you an effective annual rate, let's call it I, and you want to calculate the equivalent nominal rate compounded quarterly, we'll call that I to the power of 4. The formula enforces that equivalence. The quantity 1 plus I equals the quantity 1 plus I to the 4 divided by 4, all raised to the power of 4.
Wow, okay, so the left side is the total growth factor for 1 year.
Right. And the right side is the growth factor you get by compounding the quarterly rate, which is I to the 4 divided by 4, 4 separate times. You are solving for that perfect fractional rate that, when compounded quarterly, exactly matches the true annual rate I.
It's a crucial adjustment. It ensures we maintain mathematical consistency between the duration of the rate and the duration of the period N. Okay, we have the engine, the interest rate, and we have the destination, which is the future payment. Now, let's look at the foundational formula for calculating the present value of a single one-time payment. This is really the cornerstone of all PV analysis.
The standard formula, using compound interest, is PD equals C divided by the quantity 1 plus I raised to the power of N. Now, I know that looks intimidating, but let's just break down the variables conceptually so you can visualize what's happening.
Okay, so C is the future amount of money you're discounting. It's that lump sum you expect to get.
Right. And N is the number of compounding periods between today and when you receive C.
And I is the effective interest rate for one of those compounding periods, and you have to express it as a decimal.
Notice the denominator, that whole part, 1 plus I raised to the power of N. This denominator represents the total growth that the money would have experienced if you had invested the present value today and just let it compound for N periods.
So when we divide the future amount C by this growth factor, we are, like you said before, peeling off all the accrued interest.
To find the true original starting value.
That entire term, 1 plus I raised to the negative N, is often called the present value factor.
It is. It's the multiplier that reduces the future cash amount into its present value. You can think of it as the erosion factor. It's the cost of waiting, compounded over time.
Let's make this concrete with the example from the source material. Imagine a legal settlement that promises you $1,000 exactly 5 years from now. And let's say the prevailing effective annual interest rate, the rate you could earn risk-free, is 10%, or 0.10.
Okay, we just plug those numbers in. PV equals $1,000 divided by the quantity 1 plus 0.10, all raised to the 5th power.
The denominator, 1.10 to the 5th power, comes out to about 1.6105. So we divide 1,000 by 1.6105.
And the calculation yields a present value of approximately $620.92.
The interpretation here is everything. At a 10% effective annual discount rate, you should be financially indifferent.
That's the key word, indifferent.
Between receiving $1,000 in 5 years or receiving $620.92 today.
Because if you took that $620.92 and you invested it today at 10% compounded annually, you would have exactly $1,000 5 years from now. This $620.92 is the fair market price for that future promise.
That's a powerful decision-making tool. So if a bank offered to buy your $1,000 in 5 years promise for, say, $650 today,
you should take it immediately.
Because it's more than the mathematically fair price of $620.92.
Absolutely. But let's remember, this formula has a powerful dual use beyond just traditional investment discounting. We can use it to assess the erosion of purchasing power due to inflation.
Okay, so how does that work?
Instead of using the rate of return for I, you substitute the anticipated future inflation rate for I. This tells you what that future amount C will actually be able to buy in today's dollars.
So imagine you're due to receive a pension payment of, say, $50,000 in 10 years.
Okay, and let's assume a constant, maybe modest inflation rate of 3% over that decade. We can calculate the current purchasing power of that payment.
It would be PV equals $50,000 divided by 1.03 to the 10th power.
Right, and that denominator is about 1.3439. That means the purchasing power of your $50,000 in 10 years is only about $37,200 in today's money.
Wow. That's a substantial loss of real value just due to inflation.
It's a huge loss.
Yeah.
The formula is literally quantifying the cost of waiting that comes from inflation.
And finally, let's just revisit the simple rule of thumb here. The discount rate has an inverse relationship with the present value. The lower the rate, the higher the PV.
Right, and this is where it gets really interesting because this connects the math to economic reality.
You're talking about when central banks artificially suppress interest rates close to zero. What happens to asset valuation then?
Well, when the discount rate is very, very low, the erosion factor, that denominator in our formula, becomes much smaller. This allows the present value of all future cash flows, whether they're from a bond or a corporate profit stream, to increase dramatically.
So that's a primary driver of high asset valuations, like what we saw in the low interest rate environment of the 2010s.
It's a huge driver. If the penalty for waiting is low, the future cash is almost as valuable as cash today, which pushes up current prices. Then, if the Fed raises rates, that denominator grows, and asset prices generally decline because the cost of waiting has suddenly increased.
Okay, moving from that single beautiful lump sum to a series of payments is where this math truly starts to model real-world financial instruments.
Things like capital budgeting for a new factory or project proposals, or, of course, a mortgage.
We shift now to net present value, or NPV.
Before we can calculate, we have to properly define what a cash flow is. It's simply the movement of money either in or out of a specific entity at the end of a specific period.
And we differentiate them using signs, positive and negative.
Right. Cash flows you receive are positive. Cash flows you pay out, like for maintenance, taxes, or an initial investment, are negative. The cash flow for any single period just represents the net change in money for that specific time frame.
The crucial step here is understanding the NPV calculation process. Because PV is additive, you can add them up. Calculating NPV involves discounting each individual cash flow using the right PV factor for its own time period.
And then you sum up all those individual discounted values. You can't take a shortcut. There's no averaging.
And the resulting NPV figure is the absolute current net economic value of that whole sequence of transactions. This is the gonna-go number in business, isn't it?
It is. If the NPV is positive, the project is theoretically profitable at the discount rate you chose. If the NPV is negative, the project actually destroys value.
Okay, let's work through the complex example provided in our source material to really visualize this sum of individual PVs. Imagine a small project discounted at a 5% rate, so as is 0.05, and it's spread over 3 years.
Okay, so in period 1, you receive a positive $100.
In period 2, you have to pay out $50, so that's a negative cash flow.
And in period 3, you receive another $35.
So we have to calculate 3 separate PVs. For the $100 received in period 1, we just discount it back 1 period. PV1 equals 100 divided by 1.05 to the first power,
Which is $95.24. That's the present value of that first receipt.
For the negative $50 paid out in period 2, we have to discount it back 2 periods. So PV2 is negative 50 divided by 1.05 squared.
And since it's a negative cash flow, the present value is also negative, negative $45.35. That's the present cost of that future expense.
And for the $35 received in period 3, we discount it back 3 periods. PV3 is 35 divided by 1.05 cubed,
Which gives us $30.23.
So the final step is to calculate the net present value by just summing them up. 95.24 minus 45.35 plus 30.23. The result is a positive NPV of $80.12.
And that $80.12 is the current value of that entire sequence of positive and negative transactions.
So if the initial cost to launch this whole project was, let's say, $70,
It would be a profitable investment because your net present value is a positive $10.12. But if the initial cost was $90, the net present value would be negative $9.88. And the rational decision is to reject the project.
that looks pretty straightforward when the interest rate is constant. But in real-world finance, cash flow streams can introduce several complexities. What happens if the cash flows are non-consecutive? Maybe I get a payment in year 1, skip years 2 and 3, and get another payment in year 4.
The key is just remembering that the exponent n reflects the true number of compounding periods that have elapsed between today times 0 and the receipt of the cash flow.
So if you skip a year, you don't change the rate, but your exponent just jumps accordingly.
Exactly. If the first payment occurs at the end of period 1, so n is 1, and the next payment occurs at the end of period 5, then for that second calculation, n is 5. You simply use the correct power for each. N is an index of time, not an index of the number of payments.
Okay, here's a crucial technical detail that analysts run into, especially in volatile markets. What happens if the risk changes or the interest rate itself changes midstream?
This requires something called sequential discounting. And it's a necessary adjustment because you absolutely must use the discount rate that accurately reflects the risk and opportunity cost in that specific time frame. You
Right.
can't just use a blended average rate.
You have to discount the flow using the rate that's appropriate for the period it actually occurs in.
You do. Let's illustrate that with a 2-period example. Say you have a cash flow of $100 in period 1 at a 5% rate, and then a cash flow of $200 in period 2, but the rate has now jumped to 10%, maybe due to a recession or just higher perceived risk.
The first cash flow, the $100, is simple. It's just Y100 divided by 1.05 to the first power, which we already know is $95.24.
Right. But for the $200 in period 2, we have to chain the discounts. We first discount the $200 using the 10% rate back to the start of period 2. Then we have to take that resulting value and discount it back to the present using the 5% rate that was in effect during period 1.
So the calculation visually becomes $200 divided by the product of 1.10 to the first power and 1.05 to the first power. You're dividing by both discount factors.
And the calculation for that second cash flow results in about $173.16.
So summing those gives us an MPV of 95.24 plus 173.1 cents, which is $268.40.
And this shows that even if interest rates change, the fundamental principle is maintained. Every single cash flow is reduced by the cumulative discount factors between its receipt date and today. It ensures the prevailing cost of capital for every single period is properly accounted for.
All right, so once we get our heads around discounting these streams of cash flows, we can start looking at specialized financial instruments where the cash flows are really structured and highly predictable.
And the first and most common of these structured flows is the annuity.
An annuity is simply any financial arrangement that stipulates a structured payment schedule. Crucially, the payments are the same amount and they happen at regular time intervals.
And annuities are everywhere. They're used to model bonds, equipment leases, retirement payout schedules, even certain calculated depreciation charges that are used in accounting.
When we calculate their present value, though, we have to distinguish between two critical types, the annuity immediate and the annuity due. And this isn't just some small academic distinction, it actually changes the value.
It does. For an annuity immediate, payments occur at the end of each period. Think of a standard home mortgage payment or a bond coupon payment. You live there, or you benefit from the loan for the month, and then you pay at the end.
Okay, and an annuity due.
For an annuity due, payments occur at the beginning of each period. You'll sometimes hear this referred to as happening at time zero. Think of paying your rent, or an insurance premium, or contributing to a savings plan. You pay upfront for the use of the asset or the service for that period.
And mathematically, the annuity due is always more valuable than the annuity immediate simply because the money is received earlier.
Exactly. The present value of an annuity due is just the PV of annuity immediate multiplied by the quantity 1 plus I. It has one more full period to earn interest.
And the fundamental structure of the formula for both types is a closed-form calculation, right? It saves you from calculating dozens or hundreds of individual cash flows separately.
That's right. It's a summation of a geometric series, a very efficient shortcut.
Now, most of us aren't walking around with a finance degree or a scientific calculator, and those closed-form annuity formulas can look pretty dense. This is where we can introduce a truly practical nugget of knowledge for the listener, the annuity approximation rule.
Ah, yes. This approximation is a brilliant shortcut. It's designed for rapid mental arithmetic to quickly gauge the payment amount, C, that's required for an annuity or a loan.
And the formula C is approximately equal to the present value times the quantity of 1 over n plus 2/3 times I.
Right, where C is the periodic payment, PV is the loan amount, N is the number of payments, and I is the interest rate per period.
Let's illustrate the incredible utility of this with a tough example. You take a $10,000 loan, paid annually over n equals 10 years, at a pretty high 15% interest rate, so I is 0.15.
Okay, we can do the approximation mentally. We need to calculate the term in the parentheses first. 1/10 plus 2/3 of 0.15.
1/10 is just 0.1.
And 2/3 of 0.15 is also 0.1.
So the term is just 0.1 plus 0.1, which is 0.2.
Then we multiply the loan principal by that 0.2. 10,000 times 0.2.
That gives us an approximate annual payment of $2,000. And the true payment, if you were to calculate it using the complex geometric series formula, is actually $1,993. That is remarkably close.
It's accurate to within 0.35%. And the sources confirm this approximation is accurate to within plus or minus 6%, even for interest rates up to 20%. It's intended for rough, quick analysis, but its accuracy really speaks volumes about the mathematical structure of the annuity.
It lets you quickly assess a loan offer and spot a potentially misleading or bad deal without ever having to open a spreadsheet.
Precisely. Now, moving beyond finite payments, let's talk about perpetuities. These are payments that theoretically go on forever.
A perpetuity refers to a fixed periodic payment that is receivable indefinitely. I imagine they're pretty rare.
They are rare. Governments sometimes issue them, and they're used in valuation to model certain very long-lived assets or endowments.
And the calculation is remarkably simple. It comes from taking the limit of the annuity formula as the number of periods, n, approaches infinity.
It simplifies beautifully too. PV equals C divided by I.
So the present value is just the periodic payment divided by the interest rate. Why is it so simple?
Because when payments go on forever, the later payments are so heavily discounted that their present value approaches zero. All the real value is concentrated in the early years.
Okay, give me an example.
If an endowment promises to pay you $500 every year, forever, and the prevailing discount rate is 5%, the present value is just 500 divided by 0.05, which is $10,000.
Ah, because if you invest $10,000 today at 5%, it generates $500 per year forever without ever touching the principal.
That's the logic.
Okay, and finally, we arrive at one of the most practical and complex applications of PV, the valuation of a bond. A bond is fundamentally the intersection of an annuity and a lump sum.
That's a great way to put it. A bond is an interest-earning debt security with a face value, which we call F, a fixed coupon rate, R, and a maturity date. The bondholder receives regular coupon payments, typically semi-annual, and they're calculated as the face value times the coupon rate.
So the present value, which is the purchase price of that bond, has to be calculated as the sum of two distinct discounted values.
That's right. First, you have the stream of coupon payments. Since there are equal amounts received at regular intervals, you calculate them as the PV of an annuity.
And second,
The final return of the face value, F, at maturity. Since this is a single, one-time payment, you calculate it as the PV of a lump sum. You add the two resulting figures together to get the bond's fair market value today.
and the relationship between the bond's fixed coupon rate, R, and the variable market interest rate, I, is everything. That relationship determines whether the bond trades at par, a discount, or a premium.
This is the critical financial dynamic. The market rate, I, is the discount rate we use in our PV formula.
Okay, so what if the coupon rate happens to equal the market rate?
Then the bond is sold at par, meaning its PV, its price, is equal to its face value. But if the coupon rate is less than the market rate, the bond's fixed payments are less attractive than what the market is currently offering.
So to make the bond's yield comparable to the market, it has to be sold at a discount. The purchase price, the PV, is less than the face value.
Exactly. And conversely, if the coupon rate is greater than the market rate, the bond is paying a higher fixed return than new market instruments. It's highly desirable.
So investors are willing to pay a price greater than the face value. It's sold at a premium.
And that's it. So if interest rates in the market suddenly spike, all existing bonds drop in value because their fixed coupon rate is now too low compared to the new market rate, forcing their PV down to compensate. It's pure present value math driving the daily volatility of the bond market.
We've established the math and the specialized formulas. Now, let's look at how PV is used to navigate risk, to assess uncertainty, and ultimately to make investment decisions.
Before we do, let's quickly confirm the bedrock technical foundations that allow all this complex math to work so consistently. First is the principle of additivity.
Right. The PV of a bundle of cash flows is, simply put, the sum of the individual PVs. We saw that in our NPV example. You can add, subtract, and manipulate these discounted values, which is why the NPV process works so cleanly.
And second, and this is probably the most important part, are the underlying assumptions that are built into the discount rate.
What are those?
The calculation requires that the two major risks, price inflation and the risk of default, are already fully incorporated into the interest rate you're using. You're either using the real interest rate to account for purchasing power erosion.
Or you're adding a risk premium to the rate to account for the possibility of non-payment.
Exactly. If you use a rate that isn't properly risk-adjusted, your valuation will be wildly inaccurate.
Now, before we get into the practical decision-making, you mentioned something interesting for the curious listener. For continuous payments, the PV is actually mathematically related to the Laplace transform.
It is, yes. For cash flows that are modeled as a continuous stream rather than discrete annual or quarterly payments, the math shifts into continuous calculus. And the discounting factor is exactly analogous to the inverse operation that's performed by the Laplace transform. It just goes to show that this concept of discounting future value is a universal mathematical concept that scales from basic algebra right up to advanced physics.
That's fascinating. But let's focus on the reality of forecasting the future. Practitioners use PV, but the future is always uncertain. Our sources highlight two distinct flavors of the present value approach to handle this uncertainty.
Right. The first is what's called the traditional PV approach. This is the method most often taught in introductory courses. You use a single best guess set of estimated cash flows, and you discount them using a single aggregated risk-adjusted interest rate.
This rate, often called the cost of capital, is supposed to compensate for everything: market risk, credit risk, inflation risk.
Right. It's simple, it's fast, but it's totally reliant on getting that one single discount rate perfectly right.
The second is the expected PV approach. This sounds more complex.
It is far more complex, but also more robust. Instead of relying on one single guess for the future, the analyst models multiple cash flow scenarios, say a best case, a worst case, and a most likely case, and they assign a specific probability to each one of those scenarios.
And then they calculate the NPV for each one.
They do. And crucially, they use a credit-adjusted risk-free rate in this process. By calculating the expected value, which is the PV multiplied by its probability for each outcome, they separate the probability of the outcome from the time value penalty.
Then they add up the results to get a weighted average expected PV.
Exactly. This approach is superior for high-risk, volatile projects, where the variability of the cash flow is the main uncertainty, rather than the stability of the required rate of return.
The choice between these two approaches really just highlights that valuation is rarely an absolute truth. It's more of a sophisticated, structured estimate based on our assumptions about what the future holds.
And this brings us to the most critical decision in the entire PV process: choosing the interest rate itself. You can't just use the rate your bank offers. You have to start with the risk-free interest rate.
And the risk-free rate is the return you could get on the safest investment possible. Usually this is modeled on short-term government debt, like treasury bills.
It serves as the absolute minimum benchmark for any investment you're considering. If a financial project, even one that seems guaranteed, doesn't offer a rate of return that equals or exceeds this minimum risk-free rate,
You should just reject it.
you should. You would be better off simply putting your capital into the risk-free asset instead.
And if the project involves any uncertainty, which most do, you must then incorporate the risk premium.
The risk premium is the additional percentage that's added to the risk-free rate to compensate the investor for taking on that uncertainty.
So how do you determine the size of that premium?
You compare. You look at the required rates of return for other projects or assets with similar levels of risk out on the market. If a publicly traded company with a similar risk profile demands an 8% return from its investors, then your private project, with that same risk level, should also be discounted at an 8% rate.
This ensures your discount rate accounts for both the time value of money and the likelihood of actually getting those future payments.
It's critical.
So how do investors use PV to choose between competing projects that seem to offer similar returns?
They calculate the PV for all competing projects using the same appropriate risk-adjusted interest rate. And the golden rule is elegantly simple. The project with the smallest present value, meaning the least initial outlay required, is the most efficient choice.
Because it offers the same level of future return for less capital invested today.
And that is the bedrock of capital deployment decisions in corporations everywhere.
To wrap up our detailed look at valuation, let's go back in time and talk about a traditional method of valuation that was used long before complex spreadsheets and geometric series were common. It's called years purchase.
Years purchase was the traditional method, especially in real estate and land management, for valuing a future income stream as a present capital sum. Instead of complex formulas, you would simply multiply the average expected annual cash flow by a multiple known as years purchase.
Let's use the sources example. Valuing a property that's leased at a fixed rent of $10,000 per annum, and the standard practice in that area dictates using 20 years purchase.
So the valuation is simply 20 times $10,000, resulting in a present capital sum of $200,000.
Okay, so what's the fascinating aha moment here?
The aha moment is that this simple historical rule mathematically equates exactly to discounting that income stream in perpetuity at a 5% rate.
Oh, wow. Remember the perpetuity formula? PV equals C divided by I. 10,000 divided by 0.05 is 200,000.
The factor of 20 years purchase is simply the reciprocal of the discount rate. 1 divided by 0.05 is 20.
That is incredible. It shows that the fundamental economic intuition of discounting future cash flows was already in place centuries ago, even if the math was expressed differently.
And we have hard historical evidence of its use. The English crown utilized this exact methodology extensively in the early 16th century when they were setting resale prices for manors and lands seized during the dissolution of the monasteries. They had established a standard usage of 20 years purchase. They were performing present value calculations using intuitive multiples, proving the cost of waiting is a core financial concept that never changes.
That brings us to the end of our deep dive into the dollar dilemma. To quickly recap, present value is the essential tool for comparing financial promises across time, and it's defined by three core inputs: the future amount, the time until you get it, and the risk-adjusted discount rate.
And mastering these calculations, from discounting a single lump sum to valuing complex instruments like annuities and bonds, allows you to look past the superficial headline promises. You can now determine the intrinsic value of financial instruments today. You can translate future hope into current dollars.
So, what does this all mean for you, the listener? We explored the two high-level approaches to handling financial uncertainty: the traditional PV, which uses a single aggregated discount rate, and the expected PV, which actively maps out multiple probabilistic futures.
And that distinction forces us to ask a final, provocative question that really builds on all the knowledge we've discussed today.
Hmm.
When you're valuing an investment that you truly care about, say you're funding a startup or buying a long-term commercial property, should you rely on a single black box discount rate that attempts to aggregate all market, credit, and operational risk into one single number?
Mhm.
Or is it more prudent, even if it's more time-consuming, to actively map out multiple probabilistic futures, assigning weights to different potential outcomes before you estimate its current worth?
Because the choice between those two methods determines how much variability and risk you are truly willing to accept in your final valuation figure.